Traders understand from value gaps. That's easy. But still, they enter on a not correct price because they don't understand the value and the movement of the market. In this video, I'll show you the 50% rule, the difference between premium and discount, so you stop entering on a not correct place. In the previous video, we talked about breakup structures for value gaps and why I only trade for value gaps after a breakup structure. But even with the right setup, many traders still do not make money. Why? Because they enter on the wrong value. What does it mean, premium and discount? Think of the market like buying something for a business. You want to buy something cheap to sell it at an expensive price. So if something is expensive, you want to be patient until something is in a discount. If something is cheap, you're willing to buy it. The market works in the same way. We divide the price ranges in two areas, and they're called premium and discount. This is the terms we use in trading. I'll explain completely how it works and how you can find it. The 50% rule. To find this, we simply take a swing high and a swing low. Then we mark the 50% level. The easiest way is to use your pip tool. And at the end of the movie, I'll show you exactly how I do it on a live chart. Everything below is discount on the 50% level. Anything above is premium. This simple line changes the way you can enter trades. The logic about it. If the market is bullish, I want to buy it at a discounted price. If the market is bearish, we want to sell it in a premium price. The reason is very simple. Because professionals buy when the price is cheap and sell when the price is expensive. Amateurs or not professional traders, starters, just do it from everywhere. They buy when the price has already moved too far away from a premium or discount. And that's the reason why a lot of value gaps also don't work. Now combine everything that we learned from a few lessons. If you haven't watched the previous lessons, go watch them, because they're very important to all have a great structure about it. So we have to identify, first of all, in a higher time frame, what the direction of the market is going. Is it going up or is it going down? Is it bullish or bearish? Then afterwards, we have to be patient until the market shows its head. So we need a break of structure or a change in character to see that the market is actually choosing a direction that it wants to go. After that, we have patience for the value gap to show its head. If that for value gaps lays at a premium or a discounted, then we can use it if it lays correctly. If it's bullish, we need to have it in a discounted. If it's bearish, the market, we need to have that for value gap in a premium section. If that is not the way, we do not trade. For example, if the market is bullish and the value gap is in a premium, I skip the trade. We do not trade that part because the price is too expensive to actually take the trade. And the risk is much greater if you do not see the liquidity where the market is drawn to. So it's best for all to skip it. That prevents you from taking an unnecessary loss. Even if the setup looks good, because the price is already way too expensive. You have to be patient. A good trader always has patience until the market returns into discount. That is where we enter. And that's also where you get the best price for your trade. Why is this such a useful filter? This removes a lot of trades that you should not take. Now you're not just trading structure anymore. You are trading structure with the right value. That is how professionals trade and think. Now I'm going to show you how I use my FIB tool so you can actually just implement it for yourself. Let's go to that trade from yesterday that we took, and actually both of them worked. Yesterday was 11/3/2026. On NASDAQ, I'll go into a 15-minute time frame. We trade, and what happened? I'll take a bit of noise off my screen first of all, otherwise you could get. Okay, I'll mark everything on the screen, and this is how your screen should look. I'll take this one off. So a swing low, we had a swing high. This was the impulsive move that the market made. Here, we made a break of structure to the upside. This does not count. This is an internal high. That was the high. So we made a break of structure to the upside with a nice displacement. That means that the market usually continues in the same direction. We have patience until the market comes back down. Now, how do you do it? You take your FIB retracement tool, you take the low, and you drag it up all the way to that swing high. If you want to make very precise, put on the magnet. This is the easiest way. Now, anything below the 50 level would have been a great trade. You see it right here. I just put on 2 extras to actually make it a little bit more secure. I'll explain this also in another movie. Just copy them. This is how we can use them. So at the 50 level, we could have a very strong reaction. You can use the 0.62 level or the 0.78 level. Now, what do we need to find? We need to find a fair value gap after the movement went up. So this was a break of structure. We need price to come back to where fair value of price is 0.5. Here is that fair value of price. And what do we find? We find 2 15-minute fair value gaps. One at that 6.2 level, right here. I'll even make it a color. And we find one a bit lower, right here. So here we find that we had a break of structure to the upsides, came up, retested that 607 level, and then it started to rally. Where does it head to? To make a new break of structure, it needs to take out the previous high. So this is then the high, and this is that swing low. So what does the market do? It tends to go to make a new break of structure, the high, and then continues. What did it do? It made a swing high and a swing low. So you could use that same movement again over the same directions. So if we take the high and the low, if the market comes back to that 7-8 level where it's actually right now, that will mean that you have a great entry momentum to put it at that stop low. This would be here, right now where we're at. This would look like a great opportunity to long again, back to the highs, stops at the low. This is how we get the best price for our entry. Now, I'll also explain how I can remove everything, how you can also show it differently. So we have a box. This way you can do it too. You just take your rectangle and go to settings, make sure the middle line is on. You don't need a background at all, but I'll just make it so that you can see it. So if you pick a swing high and a swing low, swing high and a swing low, draw that box. The upper part of that 15 right here is a premium. This place, everything below that 50 level is discount. We start longing from discount. We start shorting from premiums. This is how you have to look at it. So anything above that 50 level is good to short if the market is heading downwards. Anything below discount is good to long when the market is actually bullish. If you want deeper information about all of this, you can always join the bootcamp that I have or use myself as a one-on-one mentor to actually implement everything that we just learned. I'm coaching this live every day with my group. I also trade live the same principles that I teach right here. But if you need somebody to hold your hand and actually make sure that you are accountable for every trade you take, you're always welcome to send me a DM or go to the website that's in the link below. So remember this rule. Structure gives you direction. For value gaps, give you a entry. Premium and discount gives you the value where your entry should be. In the next episode, I'll show you how to use limit orders to enter calmly without chasing the price. See you in the next one.